Thank you very much for that. Prateek Parekh, equity strategist at Nuvama Group, is now joining in on the show now. Prateek, morning. Thank you very much for joining in. I think you all came out with a note just on 1st of August, and it couldn't have been timed better because you're talking about how India's valuations are at the highest that we've seen. Whether you look at market cap to GDP at 150%, this was the previous peak was in 2007 when the big fall in the Indian markets, we saw that big fall in the Indian markets. And you've also highlighted the risk of extreme drawdowns when we come to such extreme valuations. What's the market called?
Yeah. Thanks, Rima, for having me over. It's always a pleasure being on the show. So I think from a market standpoint, I think clearly things have gone a bit on the higher side. Whether you look at valuations on any metric, whether it's absolute market cap to GDP, whether you look at the breadth of the valuations, where median trailing P of a BSE 500 companies at 45x, which is almost 2x of 2007, or whether you look at relative to EM, where India is the only country which has actually seen a cyclical melt up, I think things have gone very high. Now, at these high valuations, you either need the support of very large interest rate cuts or you need earnings momentum to sustain. Today, if I look at it on both the fronts, things are looking dicey. First, on the earnings part, clearly this quarter marks a decisive shift in the earnings momentum. Earnings, we have seen downgrades come through, but more importantly, profit growth is now reconciling with top line growth, and both of them are around single digits, which is not very comforting, at these valuations. But I think the large inflection points historically in Indian markets have come from global events. And I think globally is where there seems to be a regime change. For the first time in 4 years, we are seeing markets react to growth rather than inflation concerns. This, I think, is a big shift, and it will not be reversed very easily unless and until central banks go all out. There are, pockets of vulnerabilities on the global front where if delays are happen, and given how financialized global economy is, things could worsen of sorts per se. So I think from a market standpoint, we do remain a bit more on the cautious side, and we think that things are still very expensive, and global environment and earnings environment is moving on the opposite side per se, Rima.
Okay. Prateek, hi, good morning and thanks for joining us. It is an important day of trade, largely because, this is the first real signs of correction or pullback that this market is seeing after maybe 1.5 years, right? So what is the best way to approach it now? Do you raise your cash levels? Do you look for opportunities to buy into large cap names? Or do you just sit back and wait for this entire thing to play out?
Yeah, that's a great question, Sonia. And there are no easy answers for the same. But I think if you look at it, what I would do is definitely recommend increased cash levels, book profits in sectors where valuations are high and stocks have also run up a lot. And especially where earnings are very cyclical. For example, the industrial space, real estate space, autos, metals in India have seen a very strong rally, which is very idiosyncratic and disconnected from the world. So you would probably book profits there. But nonetheless, I think from a medium-term perspective, we do still have opportunities in large caps, and especially on private banks and insurance. This is a space where we strongly recommend a buy on dip kind of an approach, where these are stocks or sectors which are trading close to the record low valuations. And I think earnings concerns also, to a large extent, are there in the price. I think this is a space where we think their absolute return can be made on a 3-5 year perspective. And I think that is where one should look to incrementally raise allocations. But broadly, yes, raise cash levels, deploy more money in debt, and book profits in cyclicals is our recommendation.
For those of our viewers who are joining us right now, the big sort of headline, the news headline is at the bottom of the screen, which is that the market, the Nifty, is broken below the budget day lows. I mean, we've all basically become accustomed to, used to the idea that whatever comes, the market is broadly okay and drawdowns don't last at all. I mean, it's been and I think Prateek has been pointing this out as well, it has been an extremely unusual sort of market for the last 3-4 years, with not even a 5% pullback, which should be par for the course in a strong bull market even. I mean, we saw that in between 2005 and 2007. There were lots of pullbacks. I mean, in the next 5-6 years as well. But I think ever since the low of COVID, I mean, we basically had a one-way market with very few pullbacks along the way. Of course, I mean, late 2021, when the market topped out, that was the time around when some of these large IPOs were coming, like Paytm, etc. And then, of course, in the US, there was a bit of a correction. But even then, I mean, I think there was this sort of one phase of drawdown and nothing after that. So I think it's been a while since markets have, and that too in a synchronized way, taking a bit of a knock. The big talking point, the big story, which lies at the root of all of this, of course, is the fact that is the US, which has been the strongest market along with India, but of course for global markets is so much more important, finally going to see the so-called hard landing. So the consensus view was that it's going to be a very nice, gentle, slowing economy, which allows the Fed to cut rates, and that's the Goldilocks. So not too hard, growth still remains okay, slower. At the same time, it allows the Fed to gently bring down interest rates. So it's like a perfect landing, which has been thrown into question with the jobs data, which came out on Friday. I have to say, though, it is just one data point. You look at the last GDP number out of the US, which came, that was strong. And I could point to other data points as well. But I think because the market in the US has been so focused on, the Fed has been so focused on labor market, and that missed in a big way, people are questioning whether it's going to be, that very gentle, soft landing. And they've raised the odds that maybe it's going to be a little more uncontrolled, not as well orchestrated, hard landing, recession. I mean, for example, the other talking point in the market in the US is, and these are serious economists who are saying whether the US economy is already in a recession. And one of the indicators which many have been talking about is a Fed economist who basically came up with this rule, which essentially says that if unemployment rates if unemployment in the US on a 6-month average basis, moving average basis, rises by more than 0.5%, you're basically in a recession. And by the way, the unemployment rate on Friday, along with the jobs data, came very, very close to fulfilling that condition. And that's the reason why many are kind of talking about whether the US is already in a recession. What kind of a recession, etc., is another question. Whether it's going to be a profits recession, which we've not had in the US for a long time, I think, and which can really hurt. Remember, we had a technical recession in the US. The market just looked through it. This was back in 2022. But we've not had a profits recession. It's too early to kind of sort of call that. Just one more point is, of course, what's happening in Nikkei. It's not so much about the Nikkei. We've spoken about, what's happened to the yen. The yen has gone from, is basically rallied 10%. I think we were at about 160 odd levels. We are at about 140 odd levels now. This is the USD JPY. So 160 to 140 means the yen is rising, the dollar is falling. That is, we don't know the size of the so-called carry trade, but because the yen rate differential and other sort of market differentials were so high, the yen was so cheap, and government bond deals in Japan were so cheap, and everything else basically was higher or much higher, the differential was very, very high. That is not the case anymore with the Bank of Japan starting on a rate hiking cycle, and that is the reason, that's the other fact, the other part, which I think is causing people to wonder whether Japanese investors will repatriate money back to Japan, because Japanese assets are going to be much more attractive. But here again, the point is, will we, with what's happening on the Nikkei, with what's happening in government bond deals in Japan, is it a done thing that they will continue what they said they will do 2 weeks ago, which is a rate hiking cycle, or that is also in question? I think it's very possible that the Bank of Japan finds it very difficult to actually continue to hike interest rates in that country as it is advertised. So there are lots of moving parts. Markets are in a bit of a tizzy, a bit of a panic, but it's not one way, absolutely not. Both on the US front, a lot of recession word thrown around, and of course, with what's happened with this 10% rally in the yen and how much more you can see. I mean, I was talking to a global technical analyst who was saying that 140 is the bottom. I mean, it won't go That's it. I mean, the market should rebound from there. So we'll see. But for now, I mean, actually, we're already at about 142.98. Lots of moving parts. But for now, there is a bit of a reaction, which is not a bit of a fair bit of large reaction, which is coming through in some of these markets. Prateek, in terms of flows and the big thing which has helped markets, right, is domestic inflows, which has stayed rock steady. Looking beyond today, do you think some of this will be, the flow? Does this global narrative hurt local flows, local conviction? I mean, there's no way to tell right now, I reckon. But what's your best guess?
Yeah. So again, flows have been a bedrock of the bull market in India. I mean, that's why in India, we have seen a very cyclical, broad-based bull market, which is not seen in any other market in the world. My only two bits on flows is that flows will eventually chase fundamentals. And if fundamentals deteriorate, whether it's because of liquidity tightening or because of earnings slowing down, flows also will reverse course. I mean, generally things don't go in a one-way street. In 2007 as well, we had very strong flows. But when the global tide turned, your domestic flows also turned. So I think only betting on flows may not be the right approach in my view. I think one should look at the fundamentals, global risk appetite and the earnings, all of which right now are not in the best of the position. Now, as you rightly said, does this mean that markets will go one way down? Probably not. But nonetheless, it is still too early to call this a bottom and maybe, have a buy on dip kind of an approach of sorts per se, is what I would recommend.
Okay. Well, Prateek, thanks a lot for joining in. Appreciate your time here on CNBC TV 18. Just before we let you go, just wanted to mention that, I mean, let's not forget that if you sort of take a bird's eye view of this market in the last 15 years, the Nifty has given 12-13% compounded growth rate, irrespective of any recession, irrespective of COVID, the pandemic, etc. Right? So, Prateek, do you think this time is going to be different? Or is that the way to approach it, that keep your shopping basket ready, maybe not now, over the next couple of months or so, and buy every dip? Is that the best way to look at it?
Yeah, Sonia. I think that's again a very important question. Yes, markets have compounded 12-13%, over the last 10-12 years, and irrespective of recession. And this time, one thing which is very favorable for the market perspective is the balance sheet. Corporate leverage is very low, so your ability to bounce back is very high. Unlike the 2007 episode of the past crisis where we had recessions causing balance sheet scarring, which took a long time to revive, that is not the case this time around. But nonetheless, as I said, in markets, there are always investing opportunities, whether in bull market or bear market. And today, the main opportunity in our view lies on financial space, where we think the private banks and insurance, these are the space where one should look to buy on every dip. And as and when markets valuations do cheapen out, I think there'll be more opportunities in the broader market as well. But for now, I think these are the space where we would recommend buy on dip, and maybe not so much across the board. I mean, we need to see how situation evolves, per se, honestly, on that front.
But Prateek, internally, you all must have discussed what's happening globally and what the screen is telling us for the last few days. Do you think this global sell-off extends itself? Just talking about the pure near term, what's your own guess?
See, I think it's very difficult to call out the near-term movements. I mean, central banks have been known to be very proactive. Ever since, GFC of 2008, they have been very, very proactive. And I'm sure at such market falls will bring out a reaction from them. But I think what is fundamentally different this time is that underlying growth has really slowed down. And to that extent, the policy response will have to be much stronger. And do keep in mind that if you look at the global growth backdrop, it was only the US where growth was very strong. If you look at China and Europe, growth hasn't really been that great. So I think it's very difficult to call the next week what will happen or tomorrow what will happen. But I think directionally, if growth does cool off, I think that is a bigger concern rather than just rate cuts coming through. I mean, rate cuts are always an help, but I think they do help only once rate cutting cycle is quite deep. In the initial stages, growth concerns dominate the market narratives a lot more, per se.
Just to give you an illustration of we were talking about the yen, right? A friend just messaged, he's also, by the way, in the markets. Yeah, he'd taken his son to Japan. He just returned from Japan for, I think he was getting a black belt. So he was in Japan till last week. He said, when I left India, yen was 160, 154 when I left Japan, 148 last week and 142 today. So from 160, so I'm quoting with permission, of course, but 160 to 142. So that
incredible.
I think it's just a very, very large move by any yardstick, right? And how many we don't see these at all. But Prateek, would you agree that it's been the market went up in such a fashion, such an unusually strong fashion. Nothing matters. Like I kept using the word Teflon coated because bulletproof, whatever you want to call it, right? That is not even very strong bull markets behave. I mean, we remember back in the day, you have decent pullbacks along the way and the market keeps going higher, right? Do you think this could be one of that, or are you now starting to say that, well, maybe, we are at some sort of a high level, peak level?
Yeah. See, it's very difficult to call it, ex ante, where we are. But I think if you look at the earnings dynamics and the global growth narrative, it gives me, I feel I would tilt more that, there could be a bit more pain before eventually markets bottom out. It's difficult to call the near-term bottom and whether this pullback will be short-lived, because what is different this time versus the past pullbacks, I think, is the change in global markets narrative. Until now, markets were more concerned when inflation prints used to be higher and when Fed rate cuts used to be priced out. For the first time, despite increased probability of Fed rate cuts, markets are actually falling, which tells you that clearly growth concerns are dominating. And if history is any guide, these concerns are more painful and see a bigger drawdown rather than inflation concerns where you see volatility, but that's very short term. And eventually, once things normalize, markets rebound. Like, for example, what happened in 2023. So I think to that extent, unlike that we have seen in the last 1.5, 2 years, this time around, at least there is a bit more decisive shift in the overall market narrative is what I would say.
Okay, well, Prateek, it was good speaking to you. Thank you so much for joining us. And as they say, right, there's no point catching a falling knife in this market. So perhaps the best thing to do is to wait and watch.